There is a lending network in America that has no app, no branch, no headquarters, and no servers. It approves loans the banks reject. It pays rent for people who have run out of options. It finds jobs, covers funerals, and moves money between strangers who never signed a contract. You have probably driven past one of its nodes 100 times. What nobody noticed is that the building with the steeple on the corner had been running a financial system the whole time. And right now, that system is going dark. Manchester, New Hampshire, 1908. A parish priest named Pierre Hevet is watching the French-Canadian families in his congregation get turned away by every bank in town. They are mill workers. They have small wages, no property, and no credit history a bank wants to see. So Heavy does something strange for a clergyman. He opens a bank inside his parish. He calls it the People's Bank of St. Mary, and its only depositors and borrowers are members of his church. Here is the detail almost everyone misses. The money was never the innovation. The innovation was the collateral. In a normal bank, you borrow against property. At St. Mary's, you borrowed against your standing in the congregation. Your neighbor's savings were the money you took home. If you skipped repayment, the penalty was social. You faced those neighbors, their families, and your pastor every Sunday for the rest of your life. Think about that for a second. The pressure of a tight community was doing the job a credit score does now, except it worked on the exact people the credit system had already written off. A loan officer in a marble lobby could afford to be wrong about you. Heavy could not. He would be handing you the communion wafer the very next Sunday. Putnam had a phrase for why a setup like this works. A community built on the habit of helping each other, he argued, runs more smoothly than one where every favor has to be settled on the spot. The same way money runs more smoothly than barter. Trust was the currency. The congregation was the ledger. The same idea had surfaced before, far from New Hampshire. Decades earlier in Germany, a mayor named Raiffeisen built the same machine in farming villages. A borrower who refused to pay could lose his place in the church and his standing among his neighbors. That single threat, the bond between people who saw each other constantly, let these tiny lenders serve farmers and workers that city banks could never touch at a profit. The same principle would later make Grameen Bank famous in Bangladesh. But it was inside American churches that the same model quietly spread the furthest. And lending was only one service running on this network. Walk into a congregation and you find a benevolence fund that quietly covers a member's rent the month they lose a job. A meal train that feeds a family through a medical crisis. A man who hears you are out of work and makes a phone call to his boss on Monday morning. Money is only the most obvious thing the network moves. Just as valuable is information, the kind that never gets posted publicly. A tip about a job opening before it is advertised. A reference that pushes one resume to the top of the stack. A used car sold cheap to a family that needs one. A spare room offered to someone between homes. Add it all up, and you get something that behaves a lot like insurance. A household that hit a brutal month did not file a claim. It showed up on Sunday, and the network absorbed the shock. The economist Robert Putnam spent years studying exactly this. He found that people who attend religious services regularly are measurably more likely to give money, to volunteer, and, most importantly here, to help other people find work. But the network's reach extended well past the people inside the building. When Putnam's team tried to measure the country's total stock of social capital, the dense web of trust and favors that actually holds a community together, they landed on a finding that should stop you cold. Religious congregations accounted for roughly half of it. Half of the entire nation's social capital was sitting inside houses of worship. More than the banks held, more than the labor unions, more than any single arm of government. The largest single reservoir of trust in the country was pooled inside congregations, and almost no one was counting it. For the people who leaned on it, the help usually arrived before they ever had to ask. If this is changing how you see the building on your corner, take a second to subscribe. This channel investigates the hidden systems that quietly move money and power every week. Now, back to the network. Now, that finding raised an obvious question. If congregations were holding that much of the nation's trust, what was just one of them actually worth in dollars? Researchers at the University of Pennsylvania built a method to find out. They studied historic congregations across Philadelphia, Chicago, and Fort Worth. The average one generated more than $1.7 million a year in value for the surrounding community. Counseling, childcare, space for clinics and recovery groups, direct cash help to families. And 87% of the people receiving that help were not even members of the church. An earlier study had already pointed the same direction. The average urban congregation was throwing off more than $140,000 a year in value just by opening its doors and its space to outreach programs. And when researchers counted who was actually walking through those doors, only about 1 in 9 visits was for worship. The rest were people using the place as what it had quietly turned into: a clinic, a pantry, a meeting hall, a bank. That is the kind of number that makes economists rewrite their assumptions. But the dollar figures still missed the part that mattered most. This network reached the people the formal system flatly refused. In 1965, in one of the most segregated cities in America, the members of Greater Galilee Missionary Baptist Church in Milwaukee kept getting denied loans and basic lines of credit. So they chartered their own credit union and ran it themselves on a volunteer basis out of the church. 60 years later, it is still open. The same exclusion that locked these families out of the banks was the exact force that built them a bank of their own. At its peak, this was not a handful of scattered experiments. In 1960, there were more than 800 Catholic credit unions in the United States alone. That number felt permanent at the time. It was not. Today, fewer than 90 remain. The federal regulator now counts around 133 active faith-based credit unions and 276 more that have already gone silent. And this is where the story takes a turn nobody planned for. Every one of those closures is a node going dark. When a congregation shrinks or shuts its doors, far more than the building is lost. The benevolence fund disappears. The job referrals stop. The emergency loan that a bank would never have approved suddenly has nowhere left to come from. And the gap does not stay empty for long. The kind of lender that moves into it often charges interest that would have horrified Pierre Hervé. It has never met you. To that lender, you are an account number and a due date. You would think someone would be sounding the alarm about a financial safety net this large quietly switching off. For the most part, nobody is. For more than a century, millions of people leaned on a banking system with no servers and no profit motive, one that ran on trust and a shared pew. As the pews empty, the thing to watch is what happens to the network underneath them. Who picks up the loan that no bank will write? The rent that no app will cover, and the phone call that finds a stranger a job? So far, nothing has stepped in to replace it. If you want more investigations into the systems hiding in plain sight, subscribe. The next one is waiting for you right now.